We are gradually coming to an end in this course, Forex Trading. We'll be discussing Module 9, Global Forex Regulations and Financial Compliance. The forex market is one of the largest financial markets globally. Due to its size and global nature, it requires regulations to ensure transparency, stability, and protection of participants. By way of module objectives, at the end of this module, students should be able to explain the importance of regulation in the forex market, describe how forex trading is regulated in different countries, identify key regulatory bodies in major financial regions, explain the role of financial compliance in preventing illegal activities, understand the KYC and AML procedures, explain how financial institutions verify and monitor clients, describe the concept of tax havens and their role in global finance, identify financial intermediaries involved in forex trading, analyze how regulators enforce laws and sanction illegal operations, then apply compliance principles in forex business and trading activities. By way of introduction, regulation is essential to maintain trust in financial systems. Without proper oversight, forex market would be exposed to fraud, manipulation, and illegal activities such as money laundering. Government and financial authorities create legal frameworks to control trading activities. These frameworks vary across countries, affecting how traders operate and the level of protection available. Financial compliance ensures that financial activities are conducted legally and ethically. It includes systems such as Know Your Customer and anti-money laundering designed to prevent financial crimes. Let's look at international legal frameworks. Forex is globally integrated but regulated locally. Each country defines its own rule, enforcement systems, and regulatory bodies to protect investors and maintain market stability. Regulations aim to protect investors, ensure transparency, prevent fraud and money laundering, and maintain financial stability. This is the purpose of regulations. Let's look at regulation structure. Regulation structure includes regulatory authorities, legal frameworks, and enforcement mechanisms such as audit, penalties, and license revocation. Alerted regulated markets. This include the USA, UK, and EU, and Canada. They have strict regulations, strong enforcement, and high investor protection, but reduced flexibility. Moderate and developing markets. They include Australia, UAE, South Africa. They provide balance, while Nigeria, Ghana, and Kenya are still developing systems with way higher risk. Let's look at financial crime. What are financial crimes? Forex markets are vulnerable to money laundering, fraud, terrorist financing, and identity theft due to large cross-border transactions. What is money laundering? This is a crime. This is the process of disguising illegal funds through placement, layering, and integration stages, often using financial systems like forex platforms. Frauds and scams. This includes fake investment platforms, Ponzi schemes, and misleading signals promising guaranteed profits. What is KYC? KYC stands for Know Your Customer. This is verifying identity, the address, and source of funds to ensure legitimacy and prevent illegal activities. This is carried out to protect investors. Then we have the AML regulations. The AML monitor transactions, detect suspicious activities, and ensure continuous account monitoring and reporting. On the global scale, for the AML framework, organizations such as the FATF, International Monetary Fund, and World Bank set international compliance standards adopted by countries. Now, what is the importance of complying with these procedures and laws? Compliance will help build trust, prevent legal issues, and ensure sustainability. Failure leads to penalties, shutdowns, and persecution. What is the concept of tax havens? Tax havens are low jurisdictions offering financial privacy and flexibility, but is associated with risks such as fraud and regulatory scrutiny. What are offshore risks? Offshore risks include reduced transparency, limited investor protection, and association with financial crime. This is known as offshore risk. Financial intermediaries. These include brokers, banks, investment firms, and prop firms as they facilitate these transactions and connect market participants. Nigeria intermediaries. These include stockbrokers, forex dealers like CBN, BDC operators, and emerging service providers with varying level of regulations. Regulatory enforcement. Illegal forex firms may be investigated, shut down, accounts frozen, and operations persecuted. This is an enforcement by the regulatory agencies. Now, what are the key lessons to take from here? The key lessons to take from here are: one, operate legally; two, avoid guaranteed profit, promises of guaranteed profit from schemes; three, ensure transparency and follow compliance rules. Now, what is the process of compliance? It includes: one, registration, register your business; two, do identity verification known as KYC; three, address confirmation; four, assessment; and ongoing monitoring. You can also do your follow anti money laundering schemes very seriously. Now, we have learned in this module has provided a comprehensive understanding of global forex regulations and financial compliance. It has highlighted the importance of legal frameworks in maintaining transparency, sustainability, and trust within the financial system. The module examines how different countries regulate forex trading, showing that regular approaches may vary across regions. It also explored financial crime prevention mechanisms, including the KYC and the anti-money laundering procedures, which are essential for protecting the integrity of financial markets. So just to recap, in this module, we looked at a lot of things. We look at highly regulated forex markets. We look at moderately. We look at the one that's not very regulated. We looked at how they help in maintaining the transparency and stability and trust within the financial system. We also looked at the know your customer. And let me give a deep understanding of the knowing your customer. So, under the KYC is if you open an app, for example, or if you open a forex account, you'll be asked to put in your BVN, your name, your date of birth, and you'll be asked to upload your NIN to be verified after 3 days or 3 working days or so. All these are known as KYC procedures. This helps so that your data can be stored in the database, so that in case anything happens, you can easily be tracked to your address or to your place. This is the importance of KYC. Then anti-money laundering. Anti-money laundering is putting policies in place to ensure that businesses do not launder money through you. They do not make money illegitimately and bring it through you as a laundering. So these are policies in place to make sure that forest businesses comply with set regulations. At the end of this module, there's an assessment Here, part A is the quiz, and part B is a report to test your understanding of this module. I'll see you in the last module.